Where is this gonna? Uh, all right. Um, Once again, thank you everyone for your patience. Welcome to our monthly econ webinar. And for those of you who are here for your first time, happy 22-5. And my name is Colin, not Albert. I'm just using Albert's th thing to host. And this is our monthly econ webinar to discuss the jobs market, inflation, what's coming down from the pipeline from a government and ecosystem point of view to discuss the economy and how it might affect you, your job market, maybe your 401k, and more. Joining us, as always, is Dr. Reilly White, who is Associate Dean and a professor with tenure at University of New Mexico. He's our resident economist and has always given us great insights on a monthly basis. And over to you, Dr. White.
Thank you, Colin. Welcome, everybody, for the economic breakdown today. Gosh, you guys asked some fantastic questions. I was fielded an incredibly motley crew of questions in the sense that they rocked because they were also varied and challenging to answer. So I'll do my best to answer those today. So thank you for submitting them ahead of time. If you did submit those questions, as always, I'm Reilly White. You can always insult me, send messages to, or ask questions in the chat window located over here, or maybe it's over here, or maybe it's above you. Wherever it is, I'm here for it, and I'm ready to rock and roll. So it's so great to see you all here. Thank you for your patience while I struggled to log in, and I promise you I was here. It was happening. I had another call, and I'm like, no, I got to get on this. This is the most important group in the history of mankind. Really, it's the greatest joy ever to talk to you guys. So I have so many things to talk about, and I was just actually working on one final slide here that I'm just going to. Uh, oh heck, we'll just I'm using all kinds of wholesome terminology here. I don't know if there are kids in the audience, but we got this. But here's what we got. So first of all, it's our monthly jobs report and macroeconomic romp. Here in Albert's list, this image created by AI. Oh, dorts. Clearly driven. Sorry, that's very funny. Melanie, you're absolutely right. Clearly, I just saw updorts. Thanks, Melanie. I don't know why I even ask AI to do anything. Those of you highly concerned about AI taking your job, as you can see, this is what we got. So I asked AI to produce an image of the near future. And this is what we've got. There's a man in a trench coat. Who is that? Maybe it's Aaron. He's out there. He's got a job for you. What's going to happen? And this is the near image of downtown San Francisco in 5 years, where the only business occupying any commercial real estate is, in fact, Albert's List. And a quick shout out to you all. It's been great. I was back in the Bay Area actually last week. So if you saw me wander around Pleasanton, or I was actually in there, I was in the peninsula too, and screwing around in various places. So if I was there and you saw me shopping for groceries, getting involved, having fun, visiting tombstones in Colma, I'm your guy. And I was right there. So Melanie says at least the U.S. flag wasn't rendered upside down. That's true. I like that. It was rendered amusingly, hanging it backwards from a lamp. That's very funny. There's so many details. The more you look at AI, the more you're like, this is kind of messed up. And we've got a lot of AI in the news lately, right? So this week, markets having discovered that indeed other countries can make AI too, and then people going, oh my goodness, there's other places that do AI. It's fun. I have my own version of an AI Turing test where I ask different AI programs the same sort of absurdist question. And it always involves the same thing. I always ask AI to write a play involving the philosopher Nietzsche encountering sentient potatoes for the first time and bringing them to his friend Hegel, another philosopher, and make it a comic play. And I still have to say, ChatGPT does have an edge, in my opinion, in the depth of humor and the expansiveness of humor over DeepSeek in answering that obviously critical function of rendering a play. So it is very good. I know I tried my best for the new Alberts List. This is good. And again, the only commercial real estate, again, occupied in downtown San Francisco, solely Alberts List. So here's what we got. Jobs report for 2024 December, our most recent month that was released. As we projected last month, and indeed the month before, the top performing sector was healthcare. Great. When you spend 17% of your GDP on something, healthcare's got to be it. They got to have jobs somewhere. So we've got 256,000 jobs added in the last month, which is a very good number, higher than what we expected. And the good news is it shows that even with if we add some, if we kind of zhuzh it a little bit for migration patterns, other things, that's a good level. That's a strong economy by any standard of this. Aaron DeepSeek R1. That's very fun. I'm going to get that. Still about healthcare, 70,000 jobs. We also added 43,000 in leisure and hospitality. Last month, I complained a little bit about the retail sector's dismal performance. This month, retail rebounded. Thanksgiving was late. People decided, hey, I should buy all kinds of stuff for my family, friends, frenemies, and enemies. And they did. And we saw a bump in retail service hiring to 43K. Usually this also falls off a bit in January. So actually, January should be okay, but then February it starts falling off. A lot of those temp workers, which a lot of retail institutions didn't hire, end up going back and finding other jobs elsewhere. So that also becomes an issue. Now we've got a labor force participation, which is unchanged at 62.5%. The amount of people who are in the labor force, who are of working age, actually working, that number, of course, has trended down since about the year 2000. Every recession that we get, this trends down. A lot of that's demographic. People get older, they retire, they're not in the labor force. But we also look at the kind of small changes that we see on a month-to-month basis to figure out if more people or fewer people are engaging in the job market altogether or dropping out and doing insane things like dropping out of the job market or going to grad school or something. But it appears right now, at least from a strength position, that the labor force participation is good. Nominal wage growth. Now, this is key, right? So wage growth has to kind of beat inflation. This is nominal, so it is not real wage growth. When we factor in inflation, though, it does beat inflation right now. Inflation numbers, 2.5%. So nominal wage growth is exceeding that amount, but it is decelerating. We do see that tendency downward. The worst performing sector in the last month for jobs was actually manufacturing. Strong US dollar means it's more expensive for foreign countries to buy our goods. And we're also going to see some adjustments here, and I'm very interested to see how manufacturing plays out with the tariff policies and other things happening in the next few months. But we got construction up 8,000, even adding 10,000 jobs in the information sector. Whoa, where are those? Are they in project management? Maybe not. Are they in something else? Are they in programming? Definitely not. But we added 10,000 in information nonetheless, and it's very interesting to see because this is a rare positive month in the area of the information sector. So this is a solid situation. Aaron says, CapEx is frozen. Nothing is predictive. He wants to bake off Solo debating Kenneth Arrow having a theater play based on Arrow's impossibility theory. I love Aaron. Aaron comes in, rockets it right up to the top. It's like PhD economics all over again. So we got a few things out here, and there's a few things I want to note. One is that when we look at the ratio of the jobs that are available versus the number of unemployed workers, there are still physically more jobs available than unemployed workers. And to the extent of we've got about 1.14 jobs per unemployed worker. And you say, well, how is that possible? How do we have more jobs than unemployed? It's the sectors. It's about what kind of jobs exist. A lot of the jobs that are available are jobs in places like leisure and hospitality, lower paying jobs, construction, where we have worker and labor shortages across the country. And those won't easily be met by where we have unemployed workers in places in more technical fields and other places, that there isn't exactly a commiserate equivalent. So somebody in the, and somebody in one area is not going to go to another area very quickly. But it's interesting to note that even though we had this post-COVID exuberance, we had 2 jobs per available unemployed worker in 2022. That's come back to normal, but it's leveled off, which is also really good to see. One fear that we had is it would drop below 1 by now, but so far we had a little bit of a bump, and that's good news in the job sector so far. So far, so good. Now, one of the things as well that we're going to talk about, and things that we should talk about in general, is we have a few big policy changes coming up on the horizon. One of those things is tariffs, and I got a few questions about that. The other one is immigration policy, which is a very interesting and contested issue involving a lot of different aspects. So one thing to note is that immigration does remain a strong boon to the U.S. economy. And one of the reasons for this is this chart on the right. Here you see the annual change in U.S. working age population. So if we go back from 2000 to today, the U.S. born change in working age population, meaning that, 18 to 50, 18 to 65-year-old demographic, has actually started to decline all the way through 2020 to 2023, when the number of workers of working age US born people actually dropped. And so who replaces that? Boom! Workers come in from other countries, filling our labor force need with foreign born workers who are of working age. Now, that is a good thing for the economy, and that powers us forward. And indeed, if you go back to the Economic Policy Institute, they estimate that roughly half of the economic growth that we experienced last year was due to the presence and availability of workers from other countries and other places. This is a big deal for the economy because these labor shortages exist in different parts of the economy. And even if we shut off the spigots globally and we say nobody can come back to the United States, we're going to suffer those labor shortages more. Good example being in, whether in New Mexico or California or Texas or other places like that, a large number of these for instance, construction workers, service sector workers, and leisure and hospitality are immigrants in some capacity. And as a consequence, you do see these sectors in particular potentially being hit very hard if some of that comes off the top, which is very, very interesting. And so this is a big thing that we should watch, especially in the next year or two. Now, I know that Trump has come off a bit on the H-1B thing. You got Elon Musk in there saying, hey, we need workers. And Trump, it's a thing. We'll see how this plays out in the long run. We still have some general nervousness. I am an academic administrator now. I'm like a full-time. I don't even get to teach anymore. I just get to wave my arms in meetings all day. But in that capacity, there's tons of, we hire, generally speaking, academia is a very meritorious international area. And almost everyone on our job market is from a different country or someplace. And so obviously, for us, it's highly important that the H-1B stuff gets sorted out in not a way that is harmful for filling these labor parts of the economy. Overall, though, generally in aggregate, and aggregates are one way to view the economy, immigration helps a lot. Now, looking at the number and share of immigrants in the U.S. labor force, we have had a boom in the last few years. That comes with some consequences as well. It does exacerbate housing shortages. It does make competition, especially if the workers are low skilled. It does increase competition for workers, especially native workers who are low income. And I don't want to say low skilled per se, but just let's call them in particular jobs that don't pay a lot. That situation, a lot of manual labor jobs, other things. You do see some wage depression in these areas that does exist, and that's been shown periodically through this. And it is a competition issue too for a lot of these workers. Overall, though, it makes the economy more vibrant and it does produce stronger aggregate economic growth. Now, in the long run here, there's some news, though. How do you feel about the economy? How are you feeling? You say, oh, great jobs report, sunshine, rainbows, look at this. Oh, no, we're worried about immigrants, but we'll see what happens. Conference Board, leading index, 10 economic indicators. So the LEI that the Conference Board tracks is basically an assumption of, hey, how do you guys feel about the economy? It's the chart of vibes. Green means good vibes. Red means bad vibes. And we've had actually over the last few quarters, one of the interesting parts is outside of a recession, we haven't had this many declines in LEI indicators over the last year and a half or so that we've seen. That's very unusual to see people's confidence in the economy drop year after year after year. And it's true. Econ Matrix, green pill, red pill. Are you a red pill or a green pill on this economy, Aaron? That's a good question. I feel like Aaron is I don't know, green pill, Aaron? What do we got? So overall, we've seen this decline in general, and that's a really big deal. So we're going to see how this pans out in the long run. Now, those of you may have gone out there and you might have said, my New Year's resolution is to do something crazy. You're going to jump out of a plane. You're going to do something else. Maybe your New Year's resolution is to get a house. And so that's also equally crazy because mortgage rates are terrible. The mortgage application index, as a consequence, is the lowest since the 90s. And we've actually seen mortgage rates, which track kind of the 10-year bond. Mortgage rates are a form of long-term investment. I knew you were a green pill there, and I knew it. Mortgage rates are a type of long-term investment that tracks the 10-year bond. And so these 30-year fixed windows that we're seeing, we're up to 7.13% on those 30-year mortgages. That is expensive. And real estate prices have gone up so much, and inventory has gone down so much that these prices have remained really, really, really high, except in a few areas, and we'll get into that. Texas and Florida being interesting outliers. They added a ton of inventory, and as a consequence, you've seen prices kind of fall back. Everything fundamentally a big supply and demand market. Oh man, Aaron says buying a house right now is in a major market is insane. It's crazy pants, isn't it? I'm sitting on here. I got a 2.5% mortgage. You can pry it out of my cold dead hands, is what I say. Oh, this is good too, by the way. Please, of course, thanks, Trevor, for putting your LinkedIn in there. Trevor's got a LinkedIn, put it in there as well. Connect to each other. Use this time to network with each other. You can also network. I also invite you. You can connect with me on LinkedIn. I don't post a lot of updates. I probably will try to do more in the future, but just great to connect with you. And you can ask me questions, whatever it is on your mind. I want you to talk about this. Talk about this. What kind of shenanigans are going on here, Reilly? I'm there for it. Just let me know. And likewise, I'll find my LinkedIn later. But anyway, one of those things. So mortgage rates are very expensive. And typically it happens in a reverse sense. House prices go down when mortgage rates are up and vice versa. But we have mortgage rates going up at such a time. We have fewer people moving state to state, which we talked about last month. And we then have this consequence of, prices just being so elevated. This is actually a historically poor time for a first-time home buyer. So if you're feeling like it's tough, if you feel like you were guilted at Thanksgiving dinner with your family saying, when I was your age, I had 13 houses and I had 15 properties and I had 28 cats and you had all these things and you can only reach half of those amounts, then the problem is the problem is not you. It is the market being historically unaffordable. We got Colin on board. Colin, what do you say to this?
Someone is asking if you can enter the presentation mode so they can read the slides a lot
Oh,
better.
yes. No, I'm making this deliberately difficult. So here's the difficult part is I have one of those 49-inch screens. So I have to change my display settings. And the reason I do it this way is I like to do like if somebody asks me a question, I can do street finance or something. So, now I went down to like, I don't like this. 1 second. So give me a second. Let me fool around with my display settings. 1 second. Let's see. What do we got here? What's my preferred? I know we got nothing but IT sector in the audience today. So I know this is kind of like, I feel like I could get the help, but I'm going to figure it out myself. We got these things. Thank you. Let's do this thing. More rage for your mortgage. It's also hard for me to view the chat window, but I'll do so. It's good. We'll kind of put it aside. I got some things here. I'm used to these big screens. So thank you. How's that, Colin? Anything else? Am I missing anything else? Do you have any questions, Colin?
What will bring the mortgage rate down to 20 to 1 times?
Ooh, what's going to bring mortgages down? So the Fed's dropping rates, but they're dropping overnight rates. Mortgages follow. Holly, it's good to see you, Holly. Yes, a crash that will bring mortgage rates down. So that's true too. I know. I like that. Just this thing, catastrophic thinking. That's what we do here in finance. One of the things that we can think about, yes, a crash would do it. The hard part is right now is so what's going to really, really get mortgage rates down? Mortgage rates follow the 10-year bond. And when the 10-year bond goes up and down, it often goes up and down for some very peculiar reasons. It's because in some ways that people think the future is going to be better than the past. They expect that the mortgage rates, these 10-year bond yields go up. They expect to be compensated for those long-term investments with higher rates. It is true that when the Fed lower rates, this will put a lower price this will put a pressure on the entire yield curve to drop. But it doesn't always happen that way, and it may just make the yield curve steeper, which will make us enter a growth environment. So in short, Holly's not wrong about this actually, because mortgage rates fundamentally, it's not always based on supply and demand. We have low inventory. If we can get more people to put their houses up for sale, and this is the paradoxical thing, prices will drop when there's greater inventory. And that will cause in many places, in many regions, a crash. But nobody wants these to drop because nobody needs to sell their house because, right now, consumer credit quality is actually very strong. The proportion of our household debt, for instance, that is based off of things like mortgages and credit cards, while physically a high number, is a relatively small percentage of our payment structure when we look over time. So consumers are not as stressed as we'd expect them to be at this time because everybody's sitting on these low interest rate mortgages. And so as a consequence, we can see, consumers not letting their houses go for sale and this kind of stasis continuing. So the 10-year bond has to drop and markets have to drop. And to do that, we have to see to the point adverse economic conditions happening in the future. So will that happen? It's a difficult question. I know. Look at this. Steeper
Or
housing
demand will
prices,
drop.
flashbacks 2008, says Trevor. Aaron says, forget buying a house. I think the best thing for everyone to do right now is buying a shark, just a shark Greg Norman, yeah, thing. Greg Norman t-shirt. This is what we're about here. Nothing but sharks is what's happening today. Boomers in the silent generation. Banks must be willing to lend dough for their house. True, Trevor, too. Good stuff. Good stuff. Yeah, trade their links with everybody. Connect with everybody. Make friends. Make enemies. Make lifelong enemies. That's what this presentation's about. So we're going to see how this pans out, but it is rough. Holly says stock up on cash and investments now. You can get a house, but lower expectations. Lower expectations. Story of my life, Holly. Story of my life. So Arbor Data Science, share a median income. Another way to look at the affordability threshold. In a hypothetical transaction, imagine you're a medium income person or a median income household. We know that the kind of boundary for the percent of your income that should be spent on a home is just 30%. I know those of you who are sitting in the Bay Area are going, 30%, huh? Sounds really accessible. Yeah, 30%. I paid 30% last week for my rent. But one of those things that you have here is kind of a tendency overall that these very, very expensive periods don't last a very long time. Now, we have been in a 2-year cycle where right now, if you're a median income person buying a median income property where you live, that would take 44% of your income to do. It's just not affordable, which is absolutely amazing. And then Colin/Albert, Colin speaking through Albert, says the other option, demand for housing drops if the current administration deports enough people and birthing rates continue to crash. I like the idea. We could end up in an apocalyptic population scenario where we just continue to lose population in such a way that eventually real estate becomes affordable. What a wonderful and terrible regime that would be, because we wouldn't have economic growth is driven from two wells, population growth and productivity growth. And if that happened, if we have an old population and we're declining in those ways, it's tend to be difficult to do both of those things. And Ali says, oh, interest rates, tax deductible. Oh, tax season is upon us. And Albert says, look, a bird flu epidemic. Oh, man, U.S. manufacturing productivity growth. That's a great link. I've read that article too from Aaron. Now, the market share of first-time home buyers has done this as well. It has slid from 50% as a consequence down into the 20s. This is indeed the lowest amount of home buyers that are on the market that are first-time home buyers that we've indeed ever seen in our data set. So this is a big deal. Continuing on this magical adventure, where is it not this way? Let's talk a little bit about Florida and Texas, two places that are special for completely different special reasons. Housing inventory surge. The active listings in Texas and Florida drastically increased between 2022 and 2025, like a 300% inventory surge. People offering this housing, not only housing that's built and offered for sale, but housing on the market that's for sale. And as a consequence, when you look at where we saw price adjustments downward, supply and demand, right? The amount of house available for sale versus the amount of people that demand it, we saw the prices start to drop in these markets in particular. Areas like Austin, which also put forth a huge number of multifamily homes, saw some of those prices drop as well. We got some word on the street too in that area too, so it's good. So that's what we got right now. Excellent shenanigans. So as we continue on this adventure, let's talk a little bit about where credit stands right now, because I had some questions about this, about how credit is, where we're going to go. So one aspect that I can't ignore, and one of the things that I want to talk about, especially in this market when we're looking at different things, you're looking at this and saying, oh, the economy is doing well, but it doesn't really match my personal financial situation or something like that. Very reasonable to say. We know we have about $1.1 trillion in credit card debt. Again, the largest number we've had nominally, but as a percent of debt service, we've been higher in other places. In most parts of the country, actually, the average, interestingly, if we divide that by our working age population, you arrive at somewhere around $6,000 per person for credit card debt, which seems like a lot of money. But so far we said, oh, maybe it's not a big deal because default rates were so low. Now, default rates have ticked upward. And in the fourth quarter data, most third quarter data, I should say, For 2024, we saw last year the amount of write-offs from credit card loans actually reached the highest level that we've seen since the financial crisis back in 2010. So we do know that for a segment of the population, especially, it has become difficult to maintain finances, and we are seeing a decline, a continued deterioration of consumer finances in these areas, which is why when we think about is this a boom or bust economy, it certainly is growing as an economy. But I'm not crazy pants saying that this is, it's going to go bazongas in the next 5 years, partially because of the deterioration in credit quality. We have to see this turn the corner. We expect as long as wages continue to rise faster than inflation, that over time, people will be in a healthier financial position and their credit quality will improve. But we just haven't seen that yet. Yeah, no. Are we write-offs the same as defaults? No, this is the dollar value, write-offs in billion. So we're approaching almost 50 billion in write-offs, which seems like a lot, but think of it this way. It's between, it's roughly 4% of the aggregate credit card market, Colin, about 1 trillion, a little bit more than $1 trillion. So big deal. Angela says, just started my taxes. Yay, Angela, good stuff. You're getting them in the mail. Some of you guys, like me, like to do taxes immediately. You're right there. You're trying to figure out the situation. You're trying to add the deductions. And then you say this, and some of you wait till like it's April 14th and you're like, oh, time to do it. The new SALT, state and local tax cap, is really hurting California homeowners as well. That's absolutely true. That's very interesting. So sometimes when you get instances of property tax write-offs and other things that are often beneficial for you and your bottom line is a write-off, you don't get that anymore. And then as a consequence, you recognize you'll end up paying more than you thought you would pay for taxes in a given year. So that's actually a very, very good point. Very, very perceptive as well. So let's talk about this. Ooh, Holly gives a point. File early. If someone steals your identity, they could file for you and take your refund fraudulently. A good point. Safer to file early as well. No one can steal your identity if you steal their identity first. Aaron says when people don't have homes, they will have non-mortgage debt, which is $5 trillion. If we subtract homeowners, then it's really 1.5 trillion from 100 million homeowners. Oh, that's interesting. Non-mortgage debt, which is 5 trillion. Yeah, homeowners really, that's true. That's true. It's an interesting question, but we do know that at least a percentage of the population seems to be having a rough go of it. And then we got our commercial real estate delinquency rates. So right now we talk a lot about commercial real estate. I gave a talk to our statewide construction financial management association, and they were like, we were talking about things, and the lenders and construction people were like, we're just our delinquent. What's commercial going to be? Commercial, everyone's losing money on commercial, and right now it is a rough spot to be in because our delinquency rate is some of the highest that we've seen, 11% higher than the financial crisis in the commercial sector. So if you're building these things, building office space in particular, you're losing money. Now, we expected some of that shit would shift back with this return to work phenomenon. Everybody's like, all right, Zoom was fun. Everybody get back into the coal mines and let's do this thing and make this work. But right now, we've seen we don't see that yet in the office delinquencies. And I've noticed even from firms that I speak to that have gotten rid of their headquarters and other places and gotten rid of their offices, they've downsized and done just different things with their workspaces to accommodate this. And the interesting part is I see this leveling off in the next couple of years, but it's going to be a rough go of it. Oh, Jochen, Volters. To avoid someone else filing with your identity, register on the IRS website and create an IRS PIN code. Look at that. No one else can create it with your social security number. Anyone volunteer to pay my taxes for me? No. Okay. Oh, good. These are good advice. Look at this. Trading. Solid financial advice in the chat room. What a great room this is. You guys are excellent. A minuses for everybody. Good work. All right, let's keep rocking. So we had a lot of questions, and we had a couple of questions involving equities and markets and stuff. So I got some news for you guys. So let's talk about this. You all know equity concentration is high. What do I mean by that? We talk about the Magnificent Seven stocks. We talk about other stocks that are highly concentrated in different places. And of course, this snapshot was taken before the drop in Nvidia this week and other things. Ugh. But anyway, without talking that or not talking about this, these are the largest companies in the world by equity market cap. Market cap is the price of a stock multiplied by the number of shares that are out there, right? And so if you own a share of stock, that entitles you to a share of future income. You're an owner. You can't just walk into Apple, although I've tried many times, and start taking furniture and knocking over things and, doing your best to say, I'm an equity owner and I'm part of the company, even if you own a single share. But what we've seen is that the equity levels, especially these companies, have never been bigger in the American market before. Apple itself is a $3.5 trillion company. Nvidia is a $3 trillion company. Microsoft, Google's a $2 trillion company. Amazon, and the only one, and notice that this is worldwide, there's only two international companies here. Saudi Aramco, which is, of course, the oil national oil company of Saudi Arabia, and, of course, TSMC, semiconductors in Taiwan. And we've got 8 other companies here, all the way from Apple to Broadcom, that are US based. So we have so much stuff happening. I know, you should do it. I do it every time the companies I own. It's very important. Just go in there and demand paper clips. You're an equity owner. You're an owner. You deserve this. This is what you get. This is my dividend. Just take an office chair. Those things can be very comfortable and very expensive. No, that's not actually my advice. So this is, to Holly's point, this graph is unsettling more than anything. And she's right. So when we look at the question of how concentrated the market is, if we look at the largest stock relative to the 75th percentile stock on the left axis, we are looking at, in the weight of the top 10 stocks in the S&P 500, to see the top 10 stocks be over a third of the S&P 500 is just mind-blowing. It should be, in the long run, roughly half that amount. And so we have a few winners that are dominating markets in such a significant way because they're perceived to take up huge percentages of what those future income will be. A stock price is nothing more than one big present value of all the cash flows the company is expected to make. So if we believe that, and that's really what people are trading on, then these companies have huge promises to give investors. But in the long run, we haven't really seen this ever, this concentrated, and since really 1932. So that is 3 years into the Great Depression, when our equity market was somehow, it's bizarre. And that's because we had a few large industrials that still attracted stocks at that time. Everyone was very afraid to invest in a large number of things. We saw high concentration periods in 39, right before World War II, in 64, and then 73, right as we were getting off the gold standard. And then 2000 and the tech bubble, 2009 during the Great Recession, and of course in 2020, and since then, just constantly going upward. We have never had a proxy for what is happening now before. And so that's the fascinating aspect of what's going to happen. Is it evil per se? Not necessarily. We can have a very small number of successful firms. We can look at this and say, well, you know that 30 years ago, there were twice as many publicly traded firms as there are now. There's about 4,000. There's about 8,000 30 years ago. You look at this. Oh, that's nice, Aaron. The Caravan price to equity ratio is 25,000. That's really fun. Ooh, high PE stocks. What a nice thing that MarketBeat has driven out for us. So price to earnings ratio takes the price and divides it by earnings per share. And when the number is really, really high, the stock could be overvalued because it has a really high price, but it's not making a lot of money. Even worse than a high PE is a negative PE because the company's losing money and it still has stock prices. And then there's stock prices that have low PE, somewhere around 4 or 5 or 8 or 10. And people might say they're undervalued because they're making a lot of money, but their stock price isn't that high. So it's one tool that a lot of investment managers use to gauge wealth. This one I put for no good reason in 360. It's like 360 pixels. I did this, I'm looking at this. I said, how pixelated can I make this? But it's very interesting right now across the market. And see if your own portfolio follows this. People are all in. The ratio of portfolios that are cash globally is about 3.9%. That's one of the lowest levels we've actually ever seen. People build up cash when they get a little bit worried about the market. and they spend down cash when they want to maximize their investment opportunities. And so it's very interesting that this has happened this way because we have these little dips below 4% that happen occasionally, like in 2004, and that led to we had a stream of good years after that, and that led to the mortgage crisis. And then we had, of course, this level in 2011, a stream of good years, and then kind of 2012 was weird. And so a lot of this depends on how confident people are investing in the marketplace. Shake Shack is a great deal at 700 PE. I thought they'd be making more money, considering the price of those boigas.
Wait,
So
is
anyway,
this a good state? Is this like
what's
a
that?
good state for the stock market to be so concentrated? Because I did notice that the heights of that concentrated graph were always
Yes,
preceding basically a giant crash.
very interesting. So like 2000,
No, no,
it's very
behind.
interesting. It's
Another slide
irregular,
behind.
Colin. Go on. I'm sorry.
Go backwards a bit.
Yes, backwards. Yes.
This one. So 1932, Great Depression, 1939, right before World War, 60, 73, 2000, dot-com boom, 2009. We remember, most of us remember that one. And 2020, most of us remember that one.
I,
So, um,
I would be surprised if the average age of our audience was like 7. I'd be like, what is this? We're just broadcasting in a kindergarten. But yes, I agree. So that's right. What do you think about this, Colin?
that,
What's your reaction to this? What do you make of it?
I mean, I'm not an economist, but if past performance predicts future trends, are we overdue for a correction? Is everything overvalued? Are we expecting something bad?
So this is where it gets tricky to your point. We like the equity markets to be competitive. We like the market to be not spread from an oligopolistic sort of way where you're concentrated in a few companies. We like to see a lot of companies competing in different spaces, and managing that is really, really hard. And that's a complexity of the tech area is we've seen these giants just develop that defy, in most cases, and I'm aware of the different antitrust issues that we've talked about. They defy a lot of antitrust rationale for them. And so these cases themselves, it doesn't necessarily have to be a bad thing. But when we think about this in general, it is true that it does indicate that something is screwy with our system. Sometimes these concentration levels happen ex post. Like, for instance, I know in the 1930s and the 1970s, you're in a time of economic turmoil already. And so as a consequence, it makes sense to flee or put your money in larger firms that you view are more trustworthy. And then in the year 2000, you are, to your point, prefacing the dot-com bubble, where you have such a concentration of wealth in a few areas. And I would actually say that maybe this is better reflected, but you've seen sort of this approach, and even in the bounce we saw in 2009. 2009 occurred as we were already within the corrections of 2008. Like people started a flight to quality in 2009, where they left all those companies that were questionable and entered companies that were bigger, considered safer. And so, in that sense, investors, in this sense, have had a rocky road over the last few years. They put their money in companies they view as safer. And they've also, as a consequence, left a whole bunch of pressure on these companies to produce values that are significant. So, I don't think necessarily it indicates that the economy is doomed or proceeding this. A lot of times it happens like we would expect that, if we had bad news about the economy in the next 4 years or a recession next year or something, people would move into companies they thought were safer or bigger or that couldn't go bankrupt. And so they'd probably some tech firms would be some of them. And even a market correction might not get rid of that. And that's the really interesting thing to think about. And so clearly we're saying that these tech companies have value and they're global leaders. There's so many of them with big positions in the Bay Area, and they're so close to many people's hearts. And you work for them. Many people work for several of them, and it's going to be interesting to see how this pans out, regardless. But it is a unusual circumstance. And what I'd like to see is the rest of the companies that have seen disappointing stock performance to also rise. And maybe that share of stock performance that goes to the other firms that aren't the Magnificent Seven starts increasing. Aaron and Holly says we've been overdue since 2016, and she's not wrong. Government and global influence seems to have a lot of influence too. Absolutely right. Aaron says the difference is the S&P 500 minus tech. Some cool sectors are really strong balance sheets. Fortune 2000 minus tech firms have built fortress balance sheets. Some of them have. Some of them are a little bit iffy, though, but some of these, to your point about balance sheets, if we take out tech, though, and what was that chart from last year that showed that equity performance on everyone else that wasn't the Magnificent Seven was like really surprisingly disappointing. So, despite the fact that some of these have really good financial performance, we haven't seen a lot of stock market action there. And so, I think there might be an opportunity and value in these areas, but that's something we'll have to figure out. And also, I want to delay. I'm sorry, Melanie asked a question in the Q&A. Thank you, Melanie, for your patience. About way back when we talked about the Florida housing market, and she asked, is this due to the insurance issues that we've seen in places like Florida, where insurance companies have packed up and left because of the higher perceived risk? And it is absolutely a factor in the reason that people are selling the homes, increasing their inventory, getting out of the state because they can't insure the homes. And then as a consequence, we've seen that increase in inventory. So that's absolutely the case. And where we see areas, and that's interesting too, because you might follow that and say, well, Palisades fire, is that going to help Southern California real estate in some way? And the problem is because it's so localized in those areas, and we're looking at a lot of areas where you're looking at insurability and other insurability questions that will have to be established, it does push people out from areas that are uninsurable. And so we'll see if this pans out to other regions too, which is a really good point. Now, what do you know about markets over the next few years? So, price earnings ratio. We talked about the ratio of price divided by earnings. So, then this first chart at the left, the S&P forward price to earnings ratio. So this is what analysts think the the earnings will be, I'm sorry, and then on today's price. Today's price divided by what the forward earnings are, what analysts expect them to be. And right now, our current level, which is around 22 times, has a big fluctuation. So at this level, we've seen markets that have gone up 40%. We've seen markets that have gone down 25%. There isn't a lot of good returns in this, not a lot of good indicators that say, hey, here's what we should expect from the market this year. Now, if we switch that on the right-hand side, and this is one of these diabolical JP Morgan asset management charts. When you look at how forward PE ratios and 10-year returns look, this is really, really depressing. So at the current level of forward PE ratios that are pretty high, relatively speaking, meaning that the prices are high relative to the amount of money these companies are expected to make in the next year. This means that typically when this happens, we see a very small window of rate returns, like between 0 and 4% on average over the next 10 years. Now, think about that for a second. We've had such a magnificent run the last few years. What if the next 10 years were fantastically disappointing? This is good stuff. This is great. It's like I'm a genie visiting you after you graduate college. What imagine the next 10 years would be fantastically disappointing. I promise. I'm sorry. It's very dark. But I'm saying from this perspective, it is interesting that we have this much concentration in this area. So this chart is saying that when the forward PE is this high, the returns on the market over the next 10 years are 0 to 3%. I like Holly's like, we can solve this, diversify into other asset classes. Holly, by the way, brilliant project manager and also a former graduate student of the University of New Mexico. So onward and upward, Holly, and do good things. And if you're looking for project managers, Holly's your person. She'll manage any project, billion-dollar projects, whatever you need. Great inflation expectations. Yields have been up, equities have been down. But when we think about the relationship between inflation expectations, and I'm just talking about the equity market in the last couple of months. So stocks versus bonds. So we have a rolling correlation here on this left chart over the 2-year and 3-month bonds. And what we see that the stock bond correlation flipped positive when both asset classes suffer from rising inflation expectations. So there's some concern that inflation is going to be reinjected into the economy again. The economy will start either because inflation is going to rise prices or other things are going to happen. Asset prices as a whole usually have this effect too. And so we've seen the 10-year yield increase pretty drastically, and this usually follows. They both S&P 500 and the 10-year yield have both gone up almost in tandem for a few months now. Strong employment numbers did push yields up and equities down, and then Wednesday's inflation print and concerns about CPI reversed that trend. And so we're going to see how this ends up happening in the next few months. Now, this year in 2025. when the government spends more money than it has, which, as it turns out, is every economy that we've seen since 1996, I think. What was the last time we had a budget surplus? We issue bonds. And when we run a deficit each year, those deficits add up. The sum of all the deficits is our national debt. And so we pay for that in bonds. And bonds are, of course, when we lend the government or a corporation money, they give us interest and then they pay us back at some promised point in the future, 5 years, 10 years in the future. They pay us a coupon payment as interest, which is a fixed income. Hence, bonds are called fixed income securities. And so $6 trillion of government bonds actually come due in 2025. That's a very, very high number. And when this comes due, depending on that interest rate, the US government may trade in some low interest rate bonds for some higher interest rate bonds. And that'll increase the cost of capital for the government and also increase our interest rate service. Right now, we spend about 8% or so of our government expenditures on, or 8 to 10% now with interest rates that are higher, on interest alone on our national debt. And that's a really interesting thing. Holly says, is the generalization of China holding our debt actually true? That's a very good question. So let's answer that question realistically. So it is true China holds some of our debt, and they've actually used to hold a lot more treasuries than they do now. And they got rid of a lot of their treasuries. But more often, we see treasuries in the form of everything from your 401k that you own across the United States to just funds that are traded globally maintain a lot of these bonds. Because of the US's position still as a global reserve currency, people typically hold US debt and hold US bonds. So we owe it globally, we owe it to ourselves, we owe it to every level of government. Interesting. What percent of our debt is held by China? I have to look up that number. Aaron, is it Albert? Or Colin, I should say. Um, the holdings might be that low. Let me
Yeah,
check.
I remember looking to this. It was a
Yeah.
large. The actual percent was actually small, and I remember like the vast majority of people who hold the debt is actually Americans, but I'm sure you can find the number faster than I can.
Oh, no, I'm sure you can find it just as fast. I'm using the same interest rate, but I have to do the old-fashioned way. So right now. So yes. Yeah, looking at this, foreign investors they make up less than a third of the total. It used to be China used to hold about $1 trillion of debt a couple years ago, which was about 17%, but they've since gotten rid of a lot of it. And let me see and find a number. What do we got here? We got tick data from the Treasury. What's table 5? What do we got there? Oh, look at this. Oh, look at this, Aaron. Aaron with a classic treasury.gov website, which uses a table. Remember, I used to build these tables. In one of my first jobs I ever had, I was a website manager in the 90s for, for a basketball team in the minor leagues. And really fun. So China holds right now around $769 billion of US debt. So if we look at this in aggregate, give or take, it's not far off from that. So that is probably doop doop doop. Looking at even as the foreign holders of US debt, not a lot. To your point, 5% or so is about right, I would say.
Yeah,
That's perfect.
so about 800 out of 3,500.
Yes, and I'm just laughing at Aaron's website. This is I haven't seen a table constructed this way. This is straight up. I love it. I haven't seen a good
Oh,
HTML
yeah.
table in an age. So this made me happy. Thanks, Aaron, for sharing this magnificent link. Geocities.com/unicorn mountain/Aaron. That's that's what we got. That's what we're bringing here. It's coming back. Everyone have that. I don't know. I used to, back in the 90s, I used to, gosh, I had I don't know if anyone, when I was a kid, one of my first experiments with the internet was using Gopher. And so you kind of were like, you'd have to log in to the University of Minnesota site and get on Gopher. And man, those were the days. Anyway, less than 10%, Holly. Japan owns more. Yeah. All right. So here's what we got right now. Good question. I like the group think on this. You got a question, there'll be 50 people who find it. Intel Pentium 300 megahertz. Whoa, 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 300 megahertz in grad school. I feel like I had a 50 megahertz. I feel like that's great. 300 megahertz. This guy's a speed demon. It's a lot of hertz. A lot of pain in those days. So when we think about bonds, I'm talking about bonds a lot because they've been really disappointing over the last 10 years. And if you had them in your portfolio, you've been inevitably disappointed. I think in aggregate, if we look at the real returns of bonds since 2015, they're up like a surprisingly low amount over that entire period, annualized like 1%. Very disappointing. But here's what happens when bond yields go up, who benefits? And you get cyclicals, financial companies, value companies, energy companies, small companies do well, and chemicals if you've got them. And then who does poorly when bond yields rise? This is real estate, defensive stock, utilities, telecoms, and healthcare does poorly. When the 10-year bonds go up, figure out what happens in the marketplace. And right now they have been going up. Nobody under 40 got that. Thanks, Aaron. I know. Man, it's a I just crickets. I'm a million years old, everybody. Anonymous attendee. Oh, thank you so much. Yes, I did that. Thank you so much. I just got that Q&A too. Sorry, still catching up to the Q&A. Look at that. Colin's got all these things. Yeah, that's right. Everyone had those in those days. All right. So one thing that's been very interesting across the economy, worth noting, construction costs have risen dramatically in the last 5 years. And if you've noticed, bid prices for construction, whether it's commercial, school buildings, residential, they're up 40% across all sectors of the market since 2019. Inflation's up 20%. Bid prices are up 40%. That means we're paying more for construction across the board in the economy right now. And that is a big deal. Um, so Angela says, why does the bond yields affect sectors differently? That's a really good question. So it depends. And so a lot of companies, so one thing that bond yields affect a lot of things is a good proxy for cost of capital in a lot of places. For areas like financial firms, they improve when bond yields go up because the margins that financial firms make increase in value. And that becomes really, really important. Now, if you're on another side of this, if you're real estate, when the 10-year bond yield goes up in value or bond yields rise, that makes getting those loans more expensive. And as a consequence, fewer people are able to get those real estate loans. And if you're an asset intensive industry like utilities or telecom or any of these big places that build big, heavy things like defensives, then you're going to be feeling higher costs of capital, a higher cost of doing business, taking out loans and making your company work. That's a really, really good question. Aaron says the West is going to be brutal for housing supplies in the next 2 years. All around the Anglosphere, I would say. A terrible time for housing. Now, people ask, one of the questions I was asked is, what are we going to see in the Fed market? Are they going to cut rates and how much will they cut them by? And so before they get cutty, we expect there's a 97% chance that they will do nothing tomorrow. That's great. 97%. Great. And this is interesting. And we expect that in the next year, and this has been clawed back a bit. This is until December of next year. There's a variance in where people think we'll land. Most people think we'll end up with about 3 cuts more or less in the next year. That may be right. So the Fed cuts every other time, maybe every third time. But people are concerned, and this spread has increased because we're not quite sure what effects things like tariffs will have on the economy, if they're going to be big effects or small effects. Because tariffs are a drag on the economy. They potentially increase inflation. They drag GDP, which at the same time should incentivize the Fed to cut rates to stimulate the economy. But then people are also worried about the economy overheating again and increasing inflation. And so we don't know which of these is going to be the bigger factor. And so because of that spread, we're estimating maybe 3 cuts, maybe 4 cuts in the next year. Holly says, is energy going to behave as predicted in the future? We're shifting those sectors. And that's a really good question. So in some senses, energy will be affected this way, as Holly points out, because government policy is shifting very much from a pro-clean energy stance to a much less pro-clean energy stance. And so the question is, what's even bigger than presidential policy is economics. And that's kind of the big picture. Economies move based on supply and demand. Different states, for instance, have different target goals on different emissions requirements. And so, yes, it does change the calculus on clean energy, especially if those subsidies are removed. But at the same time, energy companies will still be going this way anyway and improving technology, carbon credits, etc. Because when you make a decision, if you're a company, you're not just merely looking for a 3-year horizon, you're looking for a 5, 10, and 15-year horizon. What will change is the speed. of transition and the nature of that, as it would be nature, because we can speed it up a little bit or we can slow it down a bit, but economic demands will still have a big effect on it. Aaron says for Powell to keep his job, he'll have to cut 100 basis points in 2025. So you think we'll be down here, and you think Powell will need to cut 200 basis points to get renominated in 2026. That's interesting. Do you think Powell will be motivated by that? I think the Fed chair might hesitate a bit, and because he's also, I think has shown the Fed's official position is to be a neutral entity, and Powell has shown that he's trying to be as immune. I think in many ways has shown that he really doesn't care what groupthink is in this respect, and has kind of pursued his own pathway. Even when you had economic experts chanting, "Hey, we really, really need you to, do a lot of things here that can reduce and improve the economy." So I'm interested how that pans out. Holly says extreme weather is also telling us what to do. I think that'll affect a lot of consumer choices across many states as well. 100%. Aaron says Kevin Walsh will be the new Fed chair if Powell doesn't cut. Ooh, that'll be another bet we'll have to make. I don't know. That'll be interesting to see what happens. So we also had another question. Now we're getting into some rock and roll here. So strap on your fun pants if you don't have them on already. So we've got some issues. People ask me, and this happened a lot. Let's talk about robots. Robots. I had one question was like, are robots going to replace us? Are AI going to replace us? Let's talk about both things. So let's talk about robots. What do robots do to the economy? Well, one of our most famous economists of all time, who's still out there publishing, one of the most well-cited economists, Darren Acemoglu, 2020, wrote a paper about robots, studying a sample period of 1990 to 2007. And he found that each additional robot that was added in manufacturing replaced 3.3 workers. So think about that. That's Bobby, that's Tammy, that's Janice, and that's like 1/3 of Pete, all replaced. Now, robots lowered wages by about 0.4% over the same period. And that's interesting, right? So we have that combination. I know. Holly says robots make elder generations angrier and angrier. That is true. That's very funny. That's absolutely true. Aaron says Japan rules advanced robots. China uses a lot in lower and mid-level robots, and the rest of the world only uses low-end robots. An accurate statement. In the US, 4 manufacturing industries account for 70% of robots. Automakers have about 1/3 of the entire robots in use, electronics 15%, plastics and chemicals and metal manufacturers the rest. And a while ago, before AI, robots were the thing. We were worried about, what their effect was going to be on the economy. So I'm going to blow this up a bit because nobody else can see this in the cheap seats. But right now, if we look at the likelihood of a job being replaced by a robot, people thought, oh, retail salespeople, most common job, 90% chance of becoming automated. Now, we know on the other end, we've since discovered in the last few years that a lot of the automation and a lot of these things are open to a lot of shrink or theft or other things that aren't well answered by certain parts of society. And so companies are weighing, even grocery stores, on improving cashless and improving technology by putting in, self-checkouts, and at the same time weighing that against higher rates of theft and other things that are occurring in these instances, either by intention or by accident. But across the board, you think fast food, laborers, secretaries, cashiers, building cleaning workers, office clerks, registered nurses, even very high. Very, very interesting. Nurses and teachers at this level see very few jobs being replaced by robots in this fashion, although that has since changed a bit with AI. Now, let's think about what this means. I know, this is good. Holly's like, I don't know about that. AI sucks. After a while, it's clear it loses its creativity and you hate its suggestions. Aaron says robots require major capex. Nobody's wasting money on robots versus the same ROI, et cetera. Most retail robot self-checkouts are shutting down. It is a huge amount of capital for what is not a great increase in efficiency. And I'm going to move a few things around here. Let me do a few things because I was trying to screw on this because I have a lot of stuff here. I'll just make a new slide here. Let's do some street finance here. We'll duplicate a slide. I'll get rid of this one. We'll get rid of this thing up here. I was trying to say a lot of things in a short amount of time. And we'll keep that guy there. We'll delete that one. And then we'll put that guy there. There we go. Now we're cooking with Crisco. Bear with me. Oh, now we're nice and polished. Bam. So, job replacement. So the real question is about AI. And I want to put this in a framework that makes a little bit of sense. So even if something is technologically possible to replace, there are so many frictions that keep that from happening overnight. It's usually not as big a worry as you think it is. And that's period, right? I know a lot of people have talked about this. You said a lot of people are very Malthusian about this nowadays. They're like, AI, it's going to replace everything. Yes, it helps you write generic emails better than I wrote generic emails before. And there's a lot of things that it does that benefits and can improve productivity. But will AI replace jobs? Will we see massive job losses of white collar workers in these areas? And I'm not fully convinced because it's not only the technology that exists, it's a society knowing how to wield that technology that offers that propensity for innovation and change. Now, what we've seen is in the last, for instance, good example of this being telephone operators. I bring this up before. The technology to fix operators on a telephone. When you picked up a telephone, it had to say, operator, I want to connect me to the fire station. I want to yell at the fire chief. The operator would connect you. There's a physical person operating on the other side of that line to connect one person to another one. The technology to fix that was devised in the 1920s, but we still had operators through the 30s, 40s, 50s, and even up until the 1980s, in the early part of the 1980s, when the last person was laid off finally in that role. It takes decades to adjust to technological advantage. And that is a very, very important thing to remember. Now, job replacement, though, we have seen, and those of you, and I'm not invalidating any of your experiences, when we look at growth of Google search volume for jobs following the introduction of ChatGPT, we saw the volume index for across the board. The volume of Google searches for writing, engineering, software, app, and web development increased, but searches for manual intensive jobs remain relatively stable. Interesting. I remember Pac Bell 1980s, dial zero. Look at Aaron. Pacific Bell. Man. Job replacement, 21% decrease in weekly job postings for automation prone jobs after ChatGPT's introduction. Holly says nobody wants their nails done or hair done by a robot. You're not wrong. I would do it though. If I could get a robot, not like I need my nails done. If I got my hair done by a robot, if I got a haircut by a robot and it was decent and it could like scan my head, I would be like, yeah, it'd be impressive. I would rock and roll it. It'd be good. It'd take a risk though. I mean, I could lose an ear, but it might be interesting. But we do see this that in search of the job postings, automation prone jobs dropped. Writing jobs in particular saw the largest decline, about 30%, followed by software, app, and web development, and also engineering. Right now, you saw there's articles out there about ghost engineering at this time. These are engineering jobs where we can't find the engineers. They exist in a space and they aren't actually there. And so this is a question that people had. So Side, this is a good question. Are user experience and product design jobs in trouble? So I want to actually answer that specifically. I am less concerned about UX, user experience stuff right now because the intuitive nature of UX, and this is key. I think UX is actually an area where we're going to see AI aid the productivity of this by helping workers do the work they got to do with UX rather than something else. If it's user experience on the other side, and here's the reason, user experience is fundamentally you are connecting the human condition with technology, and you're the translator of those things. So I actually think that is I'm going optimistic on that one. I think. Man, that's fun. Antonio, speak yourself, Aaron. I hope not. Trying to pivot, says Jessica. Yay, I think you'll be good, Jessica. Antonio says, I gave up on the tech job market and just got a teaching job. I know. But even then, you have to ask yourself, and I was following an agency looking at, there's charter schools out there that use AI software to teach students in a very intuitive way, and they do it for 2 hours, and teaching itself is very interesting. So certainly in higher ed, we're very interested in ways, if your goal is to improve knowledge generation and dissemination, AI can be an incredible useful tool for that. And so I think it will come for jobs in that sector too. Aaron says most don't understand how robots are custom tailored to the motion requirements of the task of the assembly or packing line. It's not some lame movie version of a walking around robot. Not yet. Maybe. Holly says nothing can motivate like a great teacher, though. Good advice, Holly. That's good. Maybe if you can get there and do it. But I think that graphic design, 3D modeling jobs declined by 17% as soon as image generating AI tools existed. Now, a lot of those graphic design jobs are not high paying, right? We know that if you're a graphic designer, especially in that background, you may have found that the job offers you're getting were very low anyway. And people look at this, and even the AI generated here, there's that question, should I feel guilty about using this art, et cetera, et cetera. I would not use art otherwise for the purpose of a PowerPoint presentation, but it is having an effect on markets, especially these areas that use AI tools. Now, here's another thing as well. Here's some other data. Freelancers in automation prone fields faced 8.5% more competition, which is bids per job post, after the introduction of ChatGPT. So suddenly, you're an automation prone field, and suddenly the competition as a freelancer has increased drastically. Job complexity increased by 2%. Statistically significant, but not a lot. More skills were required for posting automation prone fields. Employer willingness to pay for automation prone jobs rose by almost 6%. So 903 jobs in the sample that they looked at required ChatGPT related skills, 88% in automation prone fields, such as software, app, and web development. Job postings explicitly listing ChatGPT skills have grown by 0.68 per week since its introduction. And we look at automation prone jobs versus manual intensive jobs. Following the introduction of ChatGPT, steep decrease in demand for automation prone jobs compared to manual prone jobs. So it is having an effect on the market. And so you ask yourself, is what I'm doing easily replaceable and replicable, just like the assembly line and just like robots? And this is interesting. God, I love, guys, I'm reading it all. This is great. Holly says it's just like Star Trek rules, isn't it? All this tech just helps and eliminates some things, but they still have, you need a bartender, you need a doctor. Exactly right. It's Star Trek rules. Exactly right. Aaron says moving to sales/GTM functions is the best fit for great technical people who are burned out and can work with people well. That's really fun. Oh, Aaron, it's like that's me, burned out and work with people well. I'm there. Give me a sales job. I'm here for it. Trevor says AI will be able to make our lives easier to manage, but human thought and creation are non-replaceable. Oh, Trevor, that's great. You're absolutely right. That's also an optimistic approach, which I like. That's good. And so this is interesting. So Jochen says very straightforward to create tactical level UX and product design artifacts with AI tools, such as the layout for a simple dialog box or even simple screens. But systems have no idea to understand complex processes. Exactly. This is kind of what I was getting at. That I said uneloquently before. Nor do they quote unquote get UX strategy. The risk is that a lot of advice, especially on social media and YouTube, focus on making designers better at low level stuff. And so the workaround is simple: avoid the UX advice on social media and go big, strategic, or go home. Really, and I love that. That's good advice. See, that's solid advice right here in the chat window. As always, from Mr. Wolters. Colin says, if you've been tactical and operational, it's important to develop strategic skills. Oh, man, this is good. Very good. Skill up is the long story of this. And if it's basic, you're too smart to be doing it anyway. You're God's sakes, it's a Tuesday evening and you're attending an economics lecture, for God's sakes. You're too smart. You care about too many things. Now let's vacillate a little bit, though, on tariffs. I'm going to go first here to this tariff slide. I showed this slide last month, but we're going to talk about this again. This is why the markets are like, inflation may be higher. So let's go back in time. How do tariffs affect the economy? Let's break it down. We thought we might have tariffs on Colombia today because, of course, the new presidential administration shipped Colombian migrants to Colombia. Colombia said no. And then we responded with a threat of tariffs on Colombia, which would have increased those imports, which for us include many things like coffee from Colombia, agricultural goods, some machine services, and other things. And likewise, Colombia is a big importer of American agricultural products as well, which we also subsidize in point. But we've had tariffs before. How do they really affect the economy? And I'm going to go back. Different presidents have done them. This is a tariff that President Obama instituted back in 2009. Same slide as last time. Put on your dark glasses and fall asleep. But I'll get into a couple new slides in a second if you remember this. They had a 35% tariff on tires from China in 2009. That did save about 1,200 tire jobs. But what happened was Chinese tire prices rose 26% in response to those tariffs. Domestic tire prices, because they had less competition, rose 3%. and Americans spent 1.1 billion more on tires. And as a consequence, they bought fewer tires because prices went up, and 3,700 retail jobs were lost. And so this is how tariffs work. They save one area of the economy at usually a greater expense in a different area of the economy. And that's kind of the big picture. So when you think about tariffs in general, the longer tariffs are maintained, and the larger tariffs are, the more of a drag on the economy it becomes. So a couple of things here. We had a question specifically about Canadian tariffs. Now, Canadian tariffs in general would affect Canada more than the United States. The United States receives 77% of Canadian exports. So a Canadian economic study done on this said a 10% U.S. tariff would cause U.S. imports to fall 10% and Canada's GDP to drop 5%. It would be devastating for the Canadian economy. And maybe a source, maybe somehow the only bright spot is we'd pull the rug out of the rocket fuel driven Canadian housing market, which is incredibly expensive. But the US has also a $353 billion export market to Canada. That's vehicles, machinery, mineral fuel, plastics. And then our exports to the US, Canada's exports to the US, well, that includes things like oil, gas, automotive vehicles, machinery, plastics, precious stones. Remember that 61% of the stuff that we import is what we call is intermediate goods. We need to put it in something else to make a final product. And so that becomes a very, very important aspect. Antonio says, so you have to wonder why they're so gung-ho on tariffs. They have to know the economic impact. They do it. Antonio's got a very good point. So, Antonio, to your point, the market's looking at this, so we know all economists understand this effect. This is something that everybody knows. So the thing is I expect what will happen. Much of this is posturing. I suspect it's to demand better deals, either on some other aspect of the economy, better trade deals, other things. With just like the button on I'm going to push the 25% tariff button unless you give me X, Y, and Z. So I think this is a negotiation tool that we have not used that aggressively, and we'll see a lot of that. It's evident, for instance, we just saw that with Colombia, and Colombia said, okay, we'll take your migrants you sent. We don't want the 25% tariffs. And they did so. And then it showed kind of that this sort of hardball might work strategically, although to what end, we don't know. And it certainly does damage the good faith trade dealings that exist between countries. So one question is that do tariffs support other things? So we talk a lot about our relationship with China in general. We have a lot of U.S. jobs that are supported by our exports to China. If we look at oil, seeds, and grains, that supports in general across the whole industry. 179,000 jobs, education, 117,000 jobs, meat products, aerospace parts, semiconductors, crops, medicines, industrial machinery. We've got thousands of jobs across the country that are based off of, in some way, trade with China. And so that becomes a really, really important thing. Sai says, North American Union, Canada and the USA, like the European Union movement of goods and people. I'm still in that traditional favor. I'm always in favor of those kind of trade blocks in general. I studied in Germany in 2004, and they had all this optimism around this and all these things. And it was the euro was going to be big, and they're like, how does it feel to be in the biggest economy in the world? And I went, well, I'm assuming you mean you have both a fiscal and a currency union. And they were like, sure. And then in 2008, they didn't. But the long story short is that kind of union is good. What we do see, though, in terms of Psi in this aspect, is that these frictions, so economics in theory works great. People move to where jobs are needed and things happen. But in practice, people are stuck in certain areas and people are moving less. We know that in Europe, there was less inter-European migration than would be logically expected from that. And that's due to the boundaries that are in place, different languages, customs, cultures, just family being close to you and those other things. There's a lot of things that keep people from moving around strategically in different ways. Wow. AI, this is really good. You guys are having this really interesting conversation. AI only interpolates. Humans can extrapolate. IOW machines can never create something dramatically different or new. Aaron says tariffs are terrible. This will demolish trade and value added. This will blast investment, slow down flows. It is a completely unnecessary drag on the U.S. economy. Completely unnecessary drag. So did the previous Trump tariffs increase U.S. manufacturing jobs? Not really. So we did cause a net reduction in manufacturing employment by 1.4%. We shielded domestic producers from competition plus 0.3%, but it was outweighed by higher production costs and retaliatory tariffs. So you do a little bit of good for a lot of bad. And so the question comes down to is in this situation, is this will be politically spun depending on whatever side of the market that you're on. It's just like the tariffs that President Obama did. President Obama could say, hey, we saved 1,200 tire jobs, but then his critics could say, well, you lost 3,700 retail jobs. The same will be the case with Trump's tariffs as well, right across the board. It's going to be a big deal. Last slide. Let's rock and roll. You've stuck here long enough, and we're almost at the conclusion. So we've got this and this. Bring it down to San Francisco and San Jose. What's happening? What's going on? We've got our information sector in the Bay Area adding 1,400 jobs between November and December. What are they? They're people to polish the AI machines in the information sector. Likewise, in San Jose, we saw an increase of 300 jobs in that. Kind of a nice positive spin on kind of a downward swinging economy. We did see across the board nothing spectacular. Increase in trade, which was very interesting in the Bay Area. We did see most things remained relatively stable. We did see a couple of hundred jobs added in other services, but then we lost another 3,000 jobs in government and 1,500 in San Jose. So not big changes right now. Overall, the unemployment rate in the Bay Area remains a little bit elevated. Normally, it is lower than the United States average. San Jose is right at the U.S. Unemployment rate right now, and San Francisco is a little higher. So we'll see what happens as this comes down to it and rock and roll it. I was in there. I was visiting. I have been to your Pleasanton. I have been to your Fremont. I have been to your San Mateo. I have seen the things, and it was good. It was excellent. It was it was wonderful and interesting. This is very exciting. You guys are having a fascinating debate here on the breakthroughs and other things that are going to happen with AI. I love the mixture of positive, negative people as well. Thank you for sticking around. And it's such an honor to give a presentation in front of you guys. So what do we got? What am I missing? Oh man. Rinse, repeat. Did I miss a question? Colin.
It was interesting because now that I work in AI, it's a ridiculous amount of questions like, are we being replaced? Is the AI overlord coming? Blah 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 blah. And we have very interesting breakthroughs recently this last weekend actually. But one of the questions we talked at the Consumer Electronics Show 22.5 was our jobs going away. And the overall consensus, even among those who work in AI, is no. It's just the nature of jobs will change. You will be just like you used to have to do math with pen and paper, and then calculators came around, and then now you have computers that can do complex mathematics for you. That didn't mean people stopped learning math and needing to do math. You just need to learn how to use the new tools. Same with coding, um, same with pretty much any technology that's appeared. And ultimately, and here's the most interesting bit that we talked about is I think businesses are running head on first into automating as much as they can before they take a step back and say, okay, what steps do we not want to automate ever? What are the steps where we want human input? Because there's two questions that remain, and these are very critical questions. At what point do you assume responsibility for output? This is extremely questionable, right? Who if you have a robot surgeon and the robot surgeon messes up, do you sue the robot? No, there has to be a human that you can sue or an organization behind it that will be the target of the lawsuit, right? So ultimately, in that specific scenario, the hospital will need to go, okay, at what point do we pull the surgeon in who knows exactly what's going on and says, this robot can do exactly what it's about to do, or else we're going to get sued, right? So that's problem number one. And problem number two is it turns out a lot of humans don't like interacting with robots. Like earlier, you guys were saying, I don't want a robot to cut my hair. And that's actually proven true time and time again. So for example, it has proven true that self-driving cars are far safer than human drivers. But a vast majority of humans would not like to have, what feels extremely anxious at the idea of letting the robot take the wheel, even though it can be proven empirically that the robot will drive significantly better than you. You still choose not to do it. So there's that little gap between what the human is comfortable with even though the robot is proven to be better as a driver. So businesses are going to slowly find and figure out like where are the parts where we either need a human to reassure the user or the customer, or we need a human so they can be the one that's the target of the lawsuit. So those are the two critical points, and then they're going to work back from there to begin slowly look at, hey, what can we not look at, or what can we not do, and so on and so forth.
Do you think, Colin, that we'll develop a level of familiarity with AI and this sort of technology where suddenly, like younger generations will adapt to it quicker? We call them horseless carriages. I don't care about cars. I want my loyal horse, Bruno, to gallop around the town in Gilroy with. And just sort of following the adjustment of other big technologies, we'll just naturally become accustomed to automated processes in more aspects of our life than we are now. Or do you think that nature is that hesitation that we're seeing, we're up against a natural human hesitation. That's often more biological than anything else. What do you think?
I think it's complicated because humans are by nature lazy. There was a time when I could memorize and recite off like, 30 different phone numbers without looking, right? How many phone numbers can you recite now? Like we grew up at a time when we had to memorize phone numbers, but now our phone just does it all for us, and we haven't had to do that in a long time. And I tutor occasionally, so the kids I'm seeing now are just they have this AI. And I remember being a child and learning math, and my teacher was like, "You'll never have a calculator in your pocket as you go," which is not true anymore. But I think there's a value in knowing how to do it if I had to. I can still do complex math if I had to. I'm slower at it now, but I can verify what the calculator or what the machine is telling me. There's this giant gap for a lot of people where they're unable to verify what the machine is telling them. And you're seeing that in even skills professions that are supposed to be able to do that, like that famous case where a lawyer submitted a case brief with ChatGPT, but it was all made up. He didn't verify this, and you think a lawyer is like the first thing the lawyer should do is verify, hey, is this about to be true or am I about to look stupid? So I think a lot of the skills that humans will need to pivot to is going to be a lot of different set of hard skills and definitely a different set of soft skills. Soft skills being very hard for robots to figure out. Um, I do writing 80% of my work and I haven't been replaced. One, because I have impeccable taste for good content. I do use ChatGPT as a starting off point. And but like the difference between me and other people is I can tell like this is a starting off point and I know like what needs to be improved, what needs to be cut, what needs to be remodified and, changed and transformed so the end result is actually good versus other people might look at that and say, well, it reads well, and they don't know how to critique it. And that taste is extremely hard for robots to develop, right? And to be able to critique that. And I have that because I put in the hours and I put in the time and the effort to learn my craft. And I've spoken to other people who are very good at their craft. Um, Artists and videographers. We're getting Google SEO2, VO2, and OpenAI just launched something called Sora, which is generating video. And they're good. They're good to my eyes, but I'm not a person who does that sort of craft. But if you ask someone who works in that field, they can look at it and instantly say, "Hey, this is not good because of XYZ," and they know exactly what they're talking about. And then they can refine it to become significantly better. So I think the thing I said earlier is if you work tactically or operationally, you should start to learn to work strategically. And if you work strategically, you should probably start to learn how the tools can impact the tactical and operational levels,
Mhm.
right? And that's the only way, humans,
Yeah.
it doesn't matter. It doesn't like you might have 20 years of work experience. It's never too late to learn a new skill. It's never too late to learn a new process. It's never too late to learn how to implement something new into your workflow, right? And then this is definitely there to help you. And if you think it can be replaced, you've probably been sitting on your laurels too long. And this is a wake-up call. Hey, learn something new, integrate this, and provide more value and become more productive.
Oh, that is true. You always work up to the capacity that you're able to. I think that's true. I like this view too. And Colin, I like your point about I like that you're like, AI doesn't have taste. Like it's lowbrow, it's rustic, it's churlish, boorish, provincial in its ability.
Yeah,
What did you just make here? In a sense, it can't handle the bougie nature that but I think your point is actually valid though. Those distinguishing human characteristics are tough to model. And even then, when you replicate it and create something else, certainly the aspect of creating something new and being able to evaluate that new thing, not merely based on historical precedents of being fed information to evaluate that on, but for in a state where you can combine your own synapses in such a way and develop kind of an opinion and a new idea about this is itself a very human characteristic that we're not there yet. But I love this idea, and I think that's true. I like this. Melanie volunteers to be a Waymo taxi driver. That's hilarious. This is great. I love it. I love it. There you go. I'm helping you. How am I here today? Where do you want to go? It'll take you. I'm just here to talk to you. What's going on?
I feel like
I am
there's not enough data yet, and we're only on day one of week two of the Trump presidency. But do you have any predictions as to where this administration will take us economically, jobs market, and stuff like that?
Good question. So right now, I think everything Colin said was on nail on the head. I think upskilling will lead you there. Jobs will help you along the way. A few questions on outlook in general. There's a lot of uncertainty around a few industries, and a lot of that depends on trade policy straight up. So we got two versions of the incoming administration that might be there. The one that says, nope, we're doing 25% tariffs on everybody all the time. That's bad news bears, and we'll likely have a lot of issues with this. But if it's like what we've just seen, where the president threatens tariffs on a different country to achieve a diplomatic end that he desires. Interestingly, and this is purely an economic approach, this is less damaging, not anything else. So I'm not talking about any of the other gamuts of things. My field is economic. That's what we're looking at right now. And so, Colin, I think a reveal just happened in the last 48 hours that, hey, it's not tariffs all the time everywhere. It is tariffs as a trade tool, which is kind of how the big investment banks have looked at this. And if that's the case, and if the Fed continues to lower rates and we don't face those inflationary pressures, I think we're going to see a recovery of different parts of the information sector. I think semiconductors will be still in demand. I think aspects of the Jobs Act that have been successful in bringing that onshoring aspect of silicon manufacturing will continue to be good. I think we'll see benefits in healthcare that will continue to grow, not benefits in the healthcare outcomes, but investment in healthcare will continue to grow because it's so freaking expensive that it is a place where a lot of private equity sees returns. I think we're going to see at the same time, though, loosening of regulations. I think we'll see a lot of that, and that will have different effects across different industries. And we'll be fighting a drag on trade policy, which will bring economies down, versus regulatory actions, which might increase it. I think we'll look at a position where we're going to see increased inequality in the next few years as well. From policy standpoint. So how you navigate all of this will depend on this. But remember, the economy is bigger than all of us. And if you continue to be part of it in one way and you upskill, do things, no matter what somebody throws at you, you can succeed. And that's the good news. And this is really good. Holly, I want to address that point too. We're exposed to a wider pool of music than ever before. I have such obscure taste in music now. This makes it harder for me to deal. Back in like 1990s, I was like, "Hey, did you listen to Green Day?" I'm like, "Yeah, everyone listened to Green Day." Nowadays, it's like I have like a obscure band interest that's listened to by like 8 people on Spotify, and I'm like, "Yes, these are the best Mongolian folk singers I've ever heard in my entire life. Please listen to them." So it also ruins the exposure to a large variety of things, ruins my ability to interact with others and find commonalities around music interests. So I love it. What a world we live in, Colin. And that's what we got tonight, folks. It's appreciated. Thank you so much. I'm so glad you all joined us. Thank you for being on board. The loyal few, the proud, the 27 who remained. A pluses for everybody. Rock and roll. This is good.
All right. Well, next month, sorry, we'll have at least a month's worth of data of the new administration, where it's going. I, for one, am quite tired of the 4 hour news cycle where Trump will say something and then all of a sudden it's been reversed and we're blocked. But we'll see where that's going and how that affects the job market. Thank you to everyone for participating and being patient with the technical kerfuffle we had at the beginning. I appreciate everyone taking the time to wait for us to sort that out and attend this as usual. Thank you, and we'll see you next month. Have a nice month.